Good evening, students. As I told you, I am going to take today foreign exchange. So due to some technical issues, it was not happened that well. So not a problem. Today we'll see to the foreign exchange. So what exactly is the foreign exchange? You know very well, when we talk about the foreign trade, it is nothing but buying and selling of the goods from one country to another country, which means from the domestic country to different country. So that is the foreign trade. When we talk about a foreign exchange, it is no way related to the trade much. Only thing is you are trading with the money and money's worth. That is with the currency. I can tell you one thing, that is like foreign exchange is nothing but you are exchanging your domestic currency with the different country currencies. So let us see what exactly is the foreign trade. What is foreign exchange? Foreign exchange is the mechanism by which the currency of one country gets converted into the currency of another country. For example, you need to travel, or else you need to buy certain different products from the different countries. You cannot go and offer them the Indian currency, that is rupees. You too know very well that is no way valid once you step out of India. Why? Because it is Indian standard rupees which is valid within the country. So once it is just outside outskirt of different country, it is just a piece of paper. It's no way treated as a currency until unless it is getting converted into different currency system. In the same way, in order to convert that currency, we need the foreign exchange. So now let us see, foreign exchange is the mechanism by which the currency of one country gets converted into currency of another country, which means you are changing the currency of domestic country to from the domestic country to another country. So whomever you are transacting with, for example US, like if you are dealing with the US or UK, American Standard Dollars, that is USD. And then if you are dealing with the UK, that is pounds and all. So F is the symbol for the pounds. So you are going to change with the pounds and dollars with Indian rupees. So the conversions of currency is done by the banks who deal in the foreign exchange. Who is dealing with this exchange market then? The exchange market is operated by the certain different banks as well as the certain different setups, like the exchange control has set up certain institutions, I can say, wherein you can go and exchange the currencies. So you cannot even see like only one particular marketplace wherein you are going to check this is the what exactly the currency is, like where we can go and like exchange our money. It is not a one particular place or a market, but these are all the different institutions are controlled by the central banks and different nationalized banks, which deals with the exchange of the control of the money. When we talk about the exchange control of the money, these banks maintains the stock one currency in the form of balance with the bank. So the bank should have a proper balance in order to exchange with certain different currency system. So it should have the proper balance of certain different country currency so that it can be transacted with. And how this works with whether you can just go and deposit your Indian currency and immediately whether you are going to get the money. No, that will not happen so immediately. You need to submit your currency system things with the check or in the form of deposits, but it takes minimum of 2 to 3 days of a time. Within 3 days you may get that entire things will be transacted if it is in the case of spot market. So I will explain you what is a spot market even in the later segment. So first let us know what is a foreign exchange. Foreign exchange is nothing but changing of your currency with the different countries currency system. So come for the next one, that is like what and all it refers with the, it also refers with to the stock of foreign currencies and the other foreign assets. So not only this currencies is used for only the certain things, but it is also used for the current assets. The Foreign Exchange Management Act, when did this act came across to? It has been come across in the year of 1999, defines Foreign exchange means foreign currency and includes deposits, credits and balances payable in any foreign currencies. What and all it deals with? It deals with the deposits as well as the credits and the balance of payment, what we take and what is we are going to maintain. BOP and BOT is very important terminology when you are looking out with the foreign exchange. So that is nothing but the payable in any form of the foreign currencies. So let us discuss about the second point, that is draft traveler's check. How this works with? It works with the traveler's check, means you can carry out the check, traveler's check, but you can deposit that check and get it converted into that particular country's currency. Apart from that, letter of credit, here it has been typed as a letter or credit. It is not or, it is letter of credit or bill of exchange expressed or drawn in India currency, drawn in India currency, but payable in any foreign currency. Means in India you are depositing that check or else that letter of credit and you are getting converted into the different country where and all you want to transact with. How this conversion will happen? Will this happen without any profitability motive? No way. So when you are doing this kind of a conversions, there is again interest rate. You need to pay the exchange control. You know, the exchange control is also going to operate with certain sum of chargeable things, like it takes the little money from you in order to do this transaction. So they say transactional money or else the conversional interest rate or a money rate. So they do it with all these interest rates. So come for the third one, that is draft traveler's check or the letter of credit or bills of exchange drawn by the banks, institutions or persons outside India but payable in Indian currency. What if a person from the outside India, he is traveling towards here, want to do some transactions, so he need to be land in India and he need to get exchanged with his money. That can also be possible, but when he is flying out of that country itself, he can get converted his money, he can deposit the money and then get conversions over here once he reach. So that can also be done. That is nothing but their draft traveler's check. So after that, let us see the nature of foreign exchange. What and all the nature of foreign exchange? Actually, this is not much in depth, but anyhow, I am going to take you through all this. Volatile and affected by the hedger, arbitrager and speculator. So when we talk about the hedging is nothing but like if you are, so let me tell you one thing. So when we talk about the hedging, it is nothing but risk bearing factor. So when we are exchanging, we need to predict that at what time, what moment this may go, price may go up. If it is going up, for example, you have invested into foreign shares and the share cost is like you have taken up 100 shares at the cost of 70. By the next 15 days later, the share rate, like the per dollar, it is like 70 rupees. Now the dollar rate changed with the 76. So you are gaining the 6 rupees actually as the profitability. That is nothing but prediction of your risk bearing factor. Like you should not go under the loss or bearing the loss factor. You should predict certain things with the profitability motive and you are going to hedge that with the exchange rates. So that should be taken into the consideration while taking up the foreign exchange. Then affected by the demand and supply. It is like, you know, when you are dealing with a different 2 to 3 countries currency system, exchange of 2 to 3 countries currency system. So you will always check with the where and all the interest rate is high when you are going to invest. For example, I am ready to invest my money into the share of different countries, shares of different countries, for example US, UK, as well as any other countries like Australia, Germany or France. So when I'm dealing with that, so I can see that there is a UK is having a little higher rate of interest, wherein even my money whichever I have invested will go very high rate of returns. So whenever you are getting higher rate of interest, you are getting higher returns, it is a profitable trade then. So that is nothing but affected by the demand and supply. That's the reason we need to check out with the demand and supply. Affected by the rate of interest. As I told you, even this as much as the demand is there, you are going to invest on that. Apart from that, where is the interest rate is little higher, we feel like to be invest in that so that we can get better returns. So later on, affected inflation rate. So we need to check what is the inflation rate. It should not be like we predicted something like it may go very high in UK pounds, but suddenly the rate fall down. When I invested it is 180 rupees, now I am getting it for a 160 rupees. There is a 20 rupees of loss in the conversion. So that should not be there. Inflation we have to check out with. And spot and forward rates are different. So all the time this foreign exchange gives us a knowledge to know about the spot rate on particular current transaction. Right away I am paying it and buying. So what is the rate of that? And forward, in future I am going to buy that particular things with the today's transaction, but that time it may be higher or lower, but I have fixed the rate on today's date. So that is the rate of difference. Then affected by the economic stability of the country. The nature of the foreign exchange says that it should not be affected by the economic stability of the country. Like affect at certain times, now itself you can see, due to this all lockdown and all, we are in the crisis. So that is not even predictable. So that economic stability you need to check out. When there is a stability, you can go for a very good investment. Now you can't even predict, or you can think of investing in a huge way because it's unpredictable. So now affected by the political condition of the country. Certain times even the war and different things we may not predict, and suddenly the certain things may start up. So at that time even the economy may go low or higher. So that is the political and economical, everything, all the conditions we need to check with the country system. It can be quoted directly or indirectly. So foreign exchange says that it is not necessary that you have to be get converted with your own things, but you can even deposit to somebody else and ask them to be change it, or else you can directly invest on shares, you can directly invest on stock markets, different thing, debentures and all, but directly or indirectly you can invest and you can change it with the currency system. So this is about the foreign exchange nature. So when we talk about the spot market, which is very very important one, and often it will be asked for the short note or a long term explanation as well. So operations of foreign exchange market, how does this market works with? Majorly, apart from those nature of things, I would like to say three major concepts of foreign exchange, that is transfer functions of foreign exchange, which is not explained in the slides, but for your viewpoint, for your knowledge sake, I would like to give you the knowledge of functions of foreign exchange. What exactly the major three functions does this foreign exchange works with? This foreign exchange works with transfer function, secondly hedging function, and then the credit function. So what exactly is the transfer function? The transfer function is nothing but the increase in the transfer purchasing power of different countries. For example, the other country is going to invest on certain different industries or certain other prospect with that currency to in India. So we are enhanced with our purchasing power. The India is getting developed with the enhanced with the financial prospect. So that is nothing but transfer functions. They like we are getting the transfer of their currency system, their currency to our country, which is increase in the purchasing power of us. So when we talk about the hedging function, I have already said we cannot predict all the time like the higher rate of the interest returns or the profitability. Certain times it may go in an adverse manner as well. When we talk about certain things like, so when we are hedging certain other different on a spot forward market, we have invested it, we predicted that it may go up to, when we are investing it is a $70, and when we are in the process of actual purchase, actual transaction of the currency, actual transfer of the currency, that time it becomes the 60, that you are with the less of 10 rupees, which means you are under a loss of 10 rupees. That risk bearing factor are, but what happens here again, if the 100 share values goes up. So you have purchased 100 shares of US dollars, dollar rate of 70 per $1. But there is a deficit of 10 now because today's rate is 60 per dollar. But the shares got increased means there is certain thing which you are predicting and getting secure with. That is nothing but your hedging function. Risk bearing factor are the be safe from loss. Hedging says that always be safe from the loss. That's the reason we predict well in advance what may happen, and we think of all better ways, and then we go for investment. So next function is credit function. What the other function this foreign exchange leads with, that is the credit function. Means different country will give the credit to other countries while in the crisis period. Within the 3 months or the stipulated time, we need to return back that credit note. So that itself is called as the bill of exchange. You might be heard about bill of exchange or bill of credit, which is very important one. So bill of credit is nothing but you are getting money from the different countries for a 3 months or a 4 months period of time on the basis of credit. So it is not again on the free of cost. Every country wants to make a little profitability. They may charge again the interest rates for this. So let us, after these three functions, let us talk about the spot market. As I told you, after the nature is nothing but the spot market. So what is the spot market or the current market? You can say current market. It is as good as you are having a money. You went to the different share market. You went and bought the 100 shares. On that particular day itself, you paid money. You got the bond of 100 shares. So in the same way, spot market for the foreign exchange is that market which handles only the spot transaction or the current transaction. Means currently you are doing the transaction and getting back the money. So here also I would like to say one thing, as it is a foreign exchange of a money, it won't happen in a one single day. It may take 2 or plus 3 days, maximum of 3 days. But it won't get extended to a week or a 15 days, because if it gets extended to 15 or a 20 days, again it will be called as a forward market. So I will explain you the second one later. Let us see the principles or the characteristics. Spot market is a daily nature. It does not trade in future deliveries. It won't happen on a future deliveries. It happens only with the current marketability, current price. On today's rate, whatever has happened, that itself will be paid on tomorrow or a day after tomorrow. So spot rate of exchange is that rate which happens to prevail at the time when transactions are incurred. So this will be happens only when the transactions are incurred. Now if the transaction is happening, that time it is getting incurred. So we are doing it right away currently. So that's the reason the current transaction is also called as the spot market transactions. So come for, let us discuss about what would be the forward market. By this you might have been already got a little idea. The spot market is on that particular point of a time, on that particular date's rate, it is fixed. That itself is called as spot market. But what would be the forward market? As the name itself says that it will be in a future thing. So forward market for a foreign exchange is that market which handles such transaction of a foreign exchange as are meant for the future delivery. This transaction is meant for the future delivery, means we have some transactions which we are willing to do it on future date. So that transactions we can see in the forward market. Today I am checking with the transaction. I am locking the transaction today itself, but I am not going to pay that on today. But for a today's rate, I am promising them to pay it on after 15 days or 20 days. So that is like as good as credit basis. So that itself is called as forward market. Principles of forward markets are the characteristics. It only creates to forward transaction. It gives the scope for forward like in the future transaction. It determines the forward exchange rate at which forward transactions are to be honored. It actually determines the forward exchange rate. So in future the forward exchange rate need to be fixed on which particular date you are going to make the payment. This is what the payment I can make it maximum, not more than that. This is the rate I am fixing for future date, not for today's date. I am fixing for future's date, and at which the foreign transaction are to be honored. That day the transaction will be honored. So come to the next one, that is exchange rate. So what do you mean by the exchange rate? Fixed exchange rate system, and then the okay, you can check out with the slide as well. Exchange rate. Fixed exchange rate system. Fixed rates provides the greater certainty for exports and imports. So when you are fixing the price, for example, today itself I am fixing one particular price to buy a certain commodities or a certain things, or exchanging of currency for today's date. Today the dollar rate is equals to 76.13. So I am fixing that particular rate for a future transactions as well. Like whatever the transaction today I am doing it, it may reach after 15 days or a today's date, but I am fixing that rate. I am locking that particular price. That is nothing but your fixed exchange system. Fixed rates provides a greater certainty for the exporters and importers. It gives the greater certainty. Definitely it may happen in that particular price. So come for the next one, that is flexible exchange rate system. This flexible exchange rate system is also called as variable rate system. So when we talk about the flexible exchange system, flexible exchange rate are floating exchange rates, change freely and are determined by the trading in forex market. So who is going to fix this foreign exchange rates? That is forex market, foreign exchange market. It is going to fix that this is what the rate for today. This might be the accurate situation, and based on this situation, this is what the affordable rate we are going to change with the currencies. Today's rate might be the 76.31. Tomorrow it may get differ. They again check with the all economical condition and different prospect, and they fix this rate as a forex market and other different institutions controlled by the central. They fix that particular price for that day again. So that is variable rate. So the transactions we are doing for imports or export is not fixed for one particular day's rate, but whatever the date it is happening in a future, whatever the rate on that particular date, it will be done with that day's rate. For example, today is 76.31 is the rate per dollar. It may go after 15 days, it may go up to the 85.00, which means 85 rupees per dollar, which got little higher than what we have today's rate. So that is how it works with foreign exchange. So when we talk after finishing the exchange rate, history of the foreign exchange. So what is the history of a foreign exchange? Foreign exchange history can be viewed as a series of